Hello and welcome to the Forex Complete Solution Intermediate course. In this module we'll be covering the further study of candlestick charts, basic shapes and doji patterns, spinning tops and long bodies, and inside and outside bars. In the basic course we covered basic candlestick formations. I now want to introduce you to a concise and in-depth study of candlestick charts and how to trade them profitably. Candlestick charts have a few advantages over bar charts and line charts. They are more visual than a bar chart and provide the user a way to identify patterns more easily. As we have previously discussed in the basic course, each candle represents an open, high, low, and closing price. This module will now introduce you to the various candlestick patterns and how they will help you to determine whether a chart is looking bullish or bearish, i.e. are the buyers or sellers now in control of the market. Before I introduce you to these patterns, I want you to be aware of the fact that you do not need to memorize each individual pattern. A tip would be to print out the sheet and keep it on your trading desk. You can then refer back to it if you spot a pattern emerging on your chart. Now I will begin with the bearish candlesticks. So to clarify, a bearish market is a market in a downtrend, a market that is selling. And also for this module, the black candles will be bearish and the white candles are bullish. Okay, so the black candles are bearish and the white candles are bullish. So I will bring up our view of the candlestick charts and I will begin to describe. So this is going to be an in-depth look at the various candlestick formations. So we're going to begin with the bearish candlesticks, and again a bearish market is a market that's selling off or a market in a downtrend. So look for these bearish patterns to emerge on your charts. So I'm going to give a detailed description now of all of these formations. So the first one we're going to begin with is called an abandoned baby bearish. Now sometimes they will be given different names. The main thing is to recognize the pattern, okay, and to recognize the pattern is the main thing, okay. So again, in the bearish market, you're looking for a downtrend. So the first thing we're going to look at before any pattern is the market in an uptrend or a downtrend, as we've discussed in the basic course. So this is an abandoned baby bearish. And like most 3-star patterns, the scenarios are similar. Okay, the primary difference is that the second star on the second day can reflect a greater deterioration in the prior day trend, depending on whether it gaps or if it's a doji and so on. And as we've discussed, a doji is a candle with no height to the real body, showing an opening and closing price where are the same. Okay, so be aware that when a doji occurs in a downtrend, it may be a reversal or just a resting place. So always look for a confirmation which are lower lows. That's what we're going to be looking for when we are trading this formation. And our next formation is advanced block bearish. So the advanced block pattern is a derivative of the 3 white soldiers, okay? And the 3 white soldiers is a pattern that consists of 3 consecutive long body candlesticks that have closed higher than the previous day. Okay, that's the 3 white soldiers. However, it must occur in an uptrend, whereas the 3 white soldiers pattern must occur in a downtrend. Unlike the 3 white soldiers, the second and third days of the advanced block show a weakness. Okay, so you've got there's more body to this candle. On the second and the third day, you've less and less volume on these candles. Okay, our next formation is the belt hold bearish. Now the market is trending when a significant gap in the direction of a trend occurs on the open. Okay, and I'll show you what we mean by a gap. Okay, a gap, as we've discussed, a gap is a break between prices on a chart. It occurs when the price makes a sharp move up or down with no trading in between. And gaps can be created by regular buying or selling pressure or a major news event. So I'm going to show you a gap that occurred recently on the USD JPY, that's the US dollar versus the Japanese yen. So over the weekend of June the 26th, 2015, we had news that the Greek banks would not be opening on the Monday. Okay, so there was no trading over the weekend, obviously, as the market was closed. So the market gapped. Okay, so the market closed on the Friday and it gapped down. And here's our gap. Okay, so when the market opened up on the Friday, it had gapped down a significant way. Okay, and that's our price gap. And these can occur through. This was quite a violent gap down. Okay, because of the Greek situation was quite volatile, especially in the currency markets. So the USD JPY gapped down, and also we can see it on our 1 hourly in our Euro USD, or yes, in our Euro USD. So it's the same gap. Okay, so this is the reason why the market gapped down on this occasion. So these are our patterns to look out for. So on a belt hold bearish, the market is trending when a significant gap in the direction of the trend. So you want to see a gap in the direction of the trend occurs on the open. From that point, the market never looks back. So as we can see again, the market never looked back. The market gapped down and it kept falling. Okay, so throughout the rest of that session and the next session, the market kept falling in the direction of the gap, which was down. Okay, so all further price action that day is in the opposite of the previous trend. So it's a trend reversal. This causes much concern and many positions will be covered or sold, which will help accentuate the reversal. Okay, so to cover a position is mainly used to indicate an act of lowering risk exposure. That's covering a position. So a major fund may cover a position. They may close some of their open position when they see a news event such as that. So it's bearish. It's a risk event, risk off. So they're taking money off the market. The breakaway bearish. Okay, it's important to realize what has been accomplished here. The trend has accelerated with a big gap, okay, as we've discussed before, and then starts to fizzle, but it still moves in the same direction. The slow deterioration of the trend is quite evident from this pattern. Finally, a burst in the opposite direction completely recovers the previous 3 days price action. What causes the reversal implication is that the gap has not been filled. A short-term reversal has taken place. So that's the bearish candle reversing the 3 days. So that's a reversal candle, and it's closed below the previous 3 days price action, and that's a bearish formation. Okay, so the dark cloud cover bearish. The market is in an uptrend. Typically in an uptrend, a long white candlestick is formed. The next day the market gaps higher on the opening. However, that is all that is remaining to the uptrend. The day after, the market drops to close well into the body of the white day. In fact, below its midpoint. Anyone who is bullish would certainly have to rethink their strategy with this type of action. Like a piercing line, a significant reversal has occurred. So you've had an up day, and then you have the market has completely sold back most of the position, and the full body is quite bearish there on our dark cloud cover. Deliberation bearish. This pattern exhibits a weakness similar to the advance block pattern in that it gets weak in a short period of time. The difference is that the weakness occurs all at once on the third day. The deliberation pattern occurs after a sustained upward move and shows trends cannot last forever. As with the advance block, defining deterioration in the trend can be difficult. Okay, so you can see two full bodies are quite long, and on the third day, the volume decreases. So the trend may be coming to an end, and you're looking for a bearish reversal. Downside gap tree methods bearish. Okay, the market is moving strongly downward. The move is extended further by another day that it gaps even more in the direction of the trend. Okay, so we can see the price is moving down. We have a gap, and the trend has continued down. The third day opens well into the body of the second day, then completely fills the gap. This gap closing move should be looked upon as supporting the current uptrend. Okay, gaps normally provide excellent support or resistance points when considered after a reasonable period of time. Because the gap is filled within one day, some other consideration should be made. If this is the first gap of the move, then the reaction third day can be considered as profit taking. Okay. A downside Tasuki gap bearish. The psychology behind the Tasuki gap is quite simple. Go with the trend of the gap. The correction third day did not fill the gap and the previous trend should continue. This is looked upon as temporary profit taking. The Japanese wily follow gaps, or windows as they used to call them. Therefore, the fact that the gap does not get filled or closed means that the previous trend should continue. See the gap here? And it did not get closed. And as we can see on our USD JPY, the gap, this was Monday morning trading, and a gap still on a Thursday. The gap here has not been filled, and until this gap gets filled, we're still in a bearish correction. Okay, so we're in no man's land, really, because if the market was to continue down, we need to sell below the gap here. That's the gap with the market gap down to, and above, to continue our uptrend, we need to close above the gap. So these are the formations that we're looking for when we're looking to open a trade, when we're looking to trade the gap. Okay, and again, this was quite a significant gap. It doesn't, that's quite a large move down, but the main thing is the gap hasn't been closed. Okay, to close the gap, the price needs to close back above where it began. Okay, so that hasn't happened. So the market is still undecided. And why is it undecided? From a fundamental point of view, the Greek situation is still unresolved. Okay, so over the weekend, we heard that the banks weren't closing. On the Monday evening, they failed to make an IMF, the International Monetary Fund. They failed to make a payment. So the market kept selling off. It's trying to recover its uptrend, as we can see the longer term uptrend on the USD JPY. It's on our monthly or our weekly. We are still in an uptrend, but right now, this week, as you can see, to continue our uptrend, we need to break back above the gap. Okay, so that's how you'd look to trade a gap. So again, all of these patterns, you have to refer back to the trend, the main trend first. So in our USD JPY, even though these are bearish formations, the main trend is still bullish, it's up. But this week, as we can see, for that to continue, see, trends will break. We never know when this will happen, okay? What will happen is, if the Greek situation gets resolved, they have a referendum coming up on Monday. Okay, so the market is going to consolidate. It's probably going to go sideways. As we said before, the market does not like indecision. So the market is undecided now. The Greek situation has yet to be resolved, and until it is resolved, the market will consolidate or go sideways. Again, the main trend is up, but to take a trade now, okay, to take a trade now is it's not a high probability trade, because we don't have the information. We don't know whether the Greek situation will be resolved. Will they be resolved and stay in the Eurozone, or will the people vote for a no vote and remove themselves from the Eurozone? We don't know. So the main money, the big hedge funds are staying quiet at the moment. They're probably staying out of the market until they get news on the event, and that's called covering. Okay, so they're covering their positions, they're taking risk out of the market, and that's what they are doing during that trade. So we go on to our next candle, engulfing bearish. Okay, an uptrend is in place when a small white body day occurs with not much volume. So there's not much volume. The trend is, again, is bearish. We have a small candle that is bullish, but there's no volume to it. The next day, price opens at new highs and then quickly falls off. So again, the black candle here is a bearish candle. The sell-off is sustained by high volume, and the price finally closes below the open of the previous day. Okay, so we had our bullish candle on day one. The price opened up but we sold back below the open of the previous day. Okay, so emotionally the uptrend has been damaged. If the next third day remains lower, then the major reversal has occurred. So we're looking for confirmation for the next day. Again, we're always looking for confirmation in the markets. We're in a small uptrend. The market didn't gap, it opened up bullish on the second day, but it sold off. Okay, it finished down. Okay, it finished below the previous open. In evening, doji star bearish. The psychology behind the pattern is similar to the evening star, except the doji star is more of a shock to the previous trend and therefore more significant. So the uptrend is stopped dead in its tracks. Okay, there's no volume to it. So we had a good bullish candle. The market is buying up, but it stopped. There's no more volume. The market was undecided. The next day, boom, the market sold off, a bearish candle. How do we get our confirmation? We need a close below the previous open, which we didn't quite get, but still we're looking for a reversal, and that's our evening star doji pattern. And evening star bearish. An uptrend has been in place, which is assisted by a long white candlestick. There is little doubt about the uptrend continuing with this type of action. Okay, the next day price gaps higher on the open. Okay, trade within a small range, close near the open. Okay, there's this small tight range. Okay, the small body shows the beginning of an indecision. So we had an uptrend, small volume, lack of volume, indecision in the market. The next day the price gaps lower and open, and what did it do? It closed below the open. Okay, so it went lower than the open, and a significant reversal of trend has taken place. So when you see a market coming to a top, look for volume to end. Okay, and we can see it here in the chart formation that the volume is starting to slow down. And where do we get our volume if we're trading? We can pick, say, the US 30 here, which is the Dow Jones 30. We go to our investing.com and we can go to historical data. Okay, we can pull up our historical data. And we can look for our volume. So here's our volume. We've got our price, our high, open, low, and close, and we can see our volumes. Okay, so if you see a volume significantly lower or significantly higher, that can signify a change in direction. Okay, so here we have 75.97 million. The next day, 104. Okay, so the volume, there's higher volume. So we can see a reference point that on our charts with the evening star, and we can see a reference point for it in actual hard data. We can check our volume. So we're constantly using our fundamentals and our technicals together to find out what exactly our volume was on that day. So we have a visual representation, and again we have a hard figure there to check our volume. The falling 3-star methods bearish. Okay, the falling 3-star methods pattern is considered a rest from trading. The psychology behind a move like this is that some doubt creeps into the ability of the trend to continue. This doubt increases as the small range reaction day takes place. However, once the bears see that the new high cannot be made, the bearishness is resumed and the new lows quickly are set. So we have consolidation at the top. The market tries to has 3 bullish days. But the market sold off. It couldn't break through the previous top, so it's a bearish formation. Okay, the price there was not much volume. Again, these are more volume in the candles that are selling. Okay, so these are the formations to look out for in your bearish market. A hanging man bearish. For the hanging man, the market is considered bullish because of an uptrend. In order for the hanging man to appear, the price action for the day must trade much lower than where it opened, then rally to close near the high. This is what causes the long lower shadow, which shows that the market just might begin to sell-off. If the market opens lower the next day, there would be many participants with long positions that would want to look for the opportunity to sell. Steve Neeson, who's one of the forefathers of candlestick charting in the West, claims that a confirmation that the hanging man is bearish might be that the body is black and the next day opens lower. Okay, so that's the hanging man bearish. Again, low volume. It was pushed up, but there was no volume to push it up. Okay, so it looks like a bearish formation. The Harami cross bearish. Okay, a Harami consists of a small body that is contained within the preceding large candle's real body. Okay, so here we have it, the Harami cross. So there's the full previous body, and the Harami cross is contained within that body. So the Harami cross starts out the same as the basic Harami pattern within the full body of the previous candle. A trend has been in place when all of a sudden the market gyrates throughout the day without exceeding the body range of the previous days. The market wouldn't break higher. Okay, what is worse, the market closes at the same price it opened. Okay, volume of this doji also dries up, reflecting a complete lack of direction by traders, and a significant reversal of trend has occurred. Okay. Harami bearish. An uptrend is in place and is perpetrated with a long white day and high volume. The next day, prices open lower and stay in a small range throughout the day, closing even lower but still within the previous day's body. In view of this sudden deterioration of trend, traders should become concerned about the strength of this market, especially if volume is light. It certainly appears that the trend is about to change. Confirmation on the third day would be a lower close. Okay, so we have our close wasn't above, and the market is low volume, and we're looking for confirmation to sell off on the next session. Identical three crows pattern. Okay, it is quite heavy selling, as you can see, three solid candles in a row over 3 sessions. This pattern resembles a panic selling that should cause additional downside action. People are really selling and getting out of the market on three solid selling days. Each day's close sets a benchmark for opening price the next day. Okay, so we never broke above, we sold. We never broke back above the previous closing, we sold. So 3 solid days, and it's a great place to set your stops. Okay, you can set your orders at the previous day's close, and the price never recovered. There was a total absence of buying power in this pattern. Okay, so major news event and the market sold off. Okay. In neck bearish. This scenario is almost identical to the on neck line, except that the downtrend may not continue quite as abruptly because there's somewhat higher close. Okay, so we're close to the neck. Okay, we were just above it. So whereas the one before, the neckline was it never closed back above, this closed just slightly above, so we need more confirmation for the downtrend to continue. Okay, a long-legged doji bearish. The long-legged doji has long upper and lower shadows, with the open and close with the open and the close very close or the same. This pattern reflects the indecision of buyers and sellers. The open and the close of the day are very close or are the same. The lower the upper body shadows are very long. The high of the day is very high at the top end of the trend. Okay, so we had a lot of price action, but there's no volume. Okay, the market is basically undecided when you see a doji here, and it's quite significant. If you see it at the top of an uptrend and you see a candle like this, it really sticks out, and you may want to consider that the market is looking to reverse, especially the next day open. You'd be looking for this point here to be resistance. Okay, and if the market could not buy back above, we may have our downtrend in place. So that's a doji, a long-legged doji. Okay, and it's quite a unique candle, and if you see it on your chart, be aware of it. The low price gapping play bearish. The low price gapping play is a bearish counterpart of the high price gapping play and leads to a renewed fall out of the stalled downtrend. The pattern this forms is a downside window for a low price congestion band. After sharp decline, the market consolidates via a series of real small bodies near the recent lows. If the price gaps under this consolidation, it is a sell signal. Okay, So if you have three bodies here, quite undecided, low volume, trying to move up, but the price is gapped down, and the price is not closed back above. So we're looking for a bearish continuation down. Meeting lines bearish. There exists an almost opposite relationship for the bearish meeting line to the relative to the dark cloud cover pattern. The bearish meeting line opens at a new high and then closes at the same point, and the same close of the previous day, while the dark cloud cover pattern drops below the midpoint. Okay, so here we have our previous close, and the market has dropped down. Okay, so you are looking for a confirmation for the market to sell below at least the midpoint. On neck bearish. The on neck line usually appears during a decline. Bearishness is increased with a long black first day. The market gaps down on the second day but cannot continue the downtrend. As the market rallies, it has stopped at the previous day's low price. This must be uncomfortable for bottom fishers who go into the market that day. The downtrend should continue shortly. Okay, so we have a strong downtrend candle, but the market rallies on the open. But where does it stop? It stops at the wick here. Okay, so this is our resistance. If you're looking to trade this, you're looking for resistance. You can just put your line across, the market stopped. And we might have 2 or 3 candles before it dips lower. But if this is a daily or a 4-hourly candle and it can't break back above that resistance line, well, our high probability trade is for the market to continue down, considering you've had a couple of previous sessions are selling down. We've had a lot of volume selling down. So if we can't break back above, we're looking to sell back down, and that is an on neck bearish. Separating lines bearish. While the market is in a downtrend, the forming of a long white body should be cause for concern for the bears, since this shows signs of a possible rally. However, the next day opens much lower. In fact, it opens the previous white day's opening price. Prices then move lower for the rest of the day and close lower, which suggests that the prior downtrend should continue. Okay, so again, you're looking, this is resistance levels. So you're looking for the candles to, again, we never know how the market is going to react the first thing on the next trading day. We may have had negative news, we may have had positive news, but again, you're always looking for price confirmation. So this is our resistance. The price couldn't close back above on this bearish candle. The price sold for the rest of the day. Our high probability trade is to keep selling, especially again, our main trend is down. Okay, if our main trend is up, we'll talk about that in a moment when we get to our bullish candles. But if our main trend is down and the price can't close back above, it's an ideal entry position and an ideal position to set our stop so the market won't close back above and will continue its downtrend. A shooting star bearish. During an uptrend, the market gaps open, rallies to a new high, then closes near its low. Okay, this action following a gap up can only be considered bearish. Okay, certainly it would cause some concern to any bulls who have had profits. Okay, so the market gapped up, hit a new high, but it couldn't sustain itself and it sold near its open, or it closed near where it opened. So again, it couldn't sustain the upward pressure and it sold off. So that's a bearish signal. Okay, side by side white lines bearish. A downtrend is further enhanced with a long black candle line followed by a large downward gap open on the next day. The market trades higher all day, but not high enough to close the gap. The third day opens lower at about the same open as the second day. Because of the resistance to further downside action, shorts are covered, causing the third day also to rally and close higher, but again, not high enough to close our gap here. Okay, so we're into resistance. We have a good downtrend. The price is rallying, but it can't close the gap. It can't close the gap and it can't close above. So again, from our USD JPY, we're not going to go long-term bullish or buying until the gap has been closed above, and we can see this formation again here, and there's our gap and the price is stalling. Okay, because of the resistance to further downside action, shorts are covered, causing the third day also to rally and close higher, but not high enough to close our gap. If enough short covering was accomplished and the rally attempt was not convincing, the downtrend should continue. Okay, so short covering, again, taking risk out of the market. 3 black crows bearish. Okay, the market is either approaching a top or has been at a high level for some time. A decisive trend move to the downside is made with a long black day. The next 2 days are accompanied by further erosion in prices caused by much selling and profit taking. This type of price action has to take its toll on a bullish mentality. So if you pull up your chart on a daily and you see these 3 solid selling candles, it's a bearish formation. Okay, especially if we're in our downtrend, there's major selling taking place in the market. Okay, 3 inside down bearish. This pattern, being a confirmation for the bearish harami, can only show success of the forecast. Okay, the bearish 3 inside down is a confirmation pattern for the bearish harami. Its pattern is defined by the first 2 days of the 3-day pattern forming a bearish harami, and the third day giving support to suggested reversal of the harami by being a black candle closing with a new low for the 3 days. Okay, and again, a harami consists of a small body that is contained within the preceding large real body. Okay, so here it is. It's contained in the previous body of the candle, and that's our harami. So these are the little signs we're looking for in the market to take our trades on the correct side of the market. The 3-line strike bearish. The market has continued in its trend, aided by the recent 3 black crows pattern. The 4th day opens in the direction of the trend, but profit taking or short covering causes the market to move strongly in the opposite direction. Okay, short covering. What is short covering? If you sold the market up here and you wanted to exit the market, when you've sold, what do you have to do to close that position? You then have to buy that position back. So you've sold up here, and now you have to close your position. You have to buy. So when you buy, the market will go up. Okay, this is known as short covering or a short squeeze. Okay, there's no change in reversal, but for sellers to get out and take their profit, they're buying the market. Okay, and this is why we have a short covering or a short squeeze in the opposite direction. This action causes considerable soul searching, but remember that the move completely eradicated the previous 3 days. This surely dried up short-term reversal sentiment, and the trend should continue in its previous direction. And how do we know? Well, it's coming into resistance. If it was really going to continue an uptrend, our trend is down. If it wanted to continue its uptrend, and it wasn't just a short squeeze, it was a continuation, well, we need the confirmation that we're going to close above, and we don't have it. Okay, so a short squeeze, especially for new traders, they might not see what is happening. But if you have a big downtrend, where are you going to take profit? At some stage, you're going to take profit because you need to close your trade. Okay, whether you've made 10 points or you've made 100 points, 100 pips, at some stage you're going to close that trade. And when you close that trade, you're buying the market, i.e. a short squeeze. So if you've thousands of people closing their position at that point, they might be looking at a Fibonacci retracement level, they might be looking at a moving average level, they might be looking at a support zone. Okay, when that gets hit, boom, the market buys, short squeeze. But if it's be contained or continued, the market would need to close back above a resistance level. If it doesn't, the market may sell off again. And we might get a continued buy and sell, and the market might go into range, or it could continue down. But this candle is the one to look for on a short covering. 3 outside down bearish. These patterns, representing the confirmation of the bearish engulfing pattern, can only show the success of the forecast. Okay, so there we have it. The market is continuing it's selling off. Okay, so we're confirming the bearish engulfing pattern. Okay, so this main candle has engulfed the bullish candle, and again the next session we're continuing down. Okay, so the success of the forecast is the market has continued to sell off. Okay, trusting bearish. Much like on neck and in neck lines, the trusting line represents a failure to rally in a down market. Because of this failure, the bulls will be discouraged and lack of buying will let the downtrend continue. Okay, so we need to close again. If we're looking for a downtrend, we'll have, even in a strong downtrend, you're going to have rallies. The market will not just fall off in a straight line 1,000 pips. It's going to come up and down. But we're looking for the market to confirm a change in direction. And to confirm a change in direction, it would need to close back above. So a trusting bearish, the market has showed is still going down, and our bullish candle can't close back above. Okay, so this will discourage bears and the market may continue to sell off. Tri-star bearish. The market has probably been in an uptrend for a long time, with the trend starting to show weakness. The bodies probably are becoming smaller. The first doji would cause considerable concern. The second doji would indicate that there was no direction left in the market. Finally, the third doji would put the last nail in the coffin of the trend. This is essentially because the pattern indicates too much indecision, and where everybody with any conviction would be reversing positions. Okay, so you're seeing 3 solid days where complete indecision, no volume. So when there's no volume and there's indecision, you're looking at a bearish formation, and the market may sell off until it comes into support. Okay, so when you see this type of formation at the top of an uptrend, you're looking for the market to reverse and sell off. So that's our tri-star bearish. 2 crows bearish. The market has an extended up move. A gap higher followed by a lower close for the second day shows that there is some weakness in the rally. The third day opens higher but not above the open of the previous day and then sells off. The sell-off closes well into the body of the first day. The action fills the gap only the second day. Okay, the bullishness has to be eroded quickly. So again, we have our trend up. The second day the market goes up, but on our third day the market takes back the uptrend profits and it's selling off. So that again we're looking for confirmation for a further sell off. So this is a bearish formation. Upside gap 2 crows bearish. Like the beginning of most bearish reversal patterns, a white body day occurs in an uptrend. The next day opens with a higher gap, fails to rally and closes lower, forming a black day. This is not too worrisome because it still did not get lower than the first day's close. On the third day, prices gapped to the higher open and then dropped to the close, lower than the previous day's close. This closing price, however, is still above the close of the white first day. The bullishness is bound to subside. How can you have 2 successfully lower closes and still be a raging bull? Okay, so 2 lower lows and lower and again lower than the previous day. Okay, so now we're going to come into our bullish candlesticks. Okay, so we're going to start with abandoned baby bullish, which sounds quite dramatic, but again, it's the formation. As I said before, some of these names will have slightly different names. The main thing is just print off this sheet and have it stuck on your wall or stuck beside your laptop or your PC. And if you see these trends developing, they're right there for you with a small little. That's why I've put this together, because you don't need too much information. You want just a description of what is happening here. So that was our bear market and how those candles react. Now we're looking at them in a bullish formation. Okay, so don't worry too much about the names or remembering the names. Some will occur more than others. Again, just print it out, stick it up on your wall or beside your laptop, and familiarize yourself with these patterns, because they will repeat. Okay, and before you know it, you'll be seeing them in real time and you'll know what they are. You won't need to look at your sheet. You'll see what they are. And if you're referring to any books or you're online, you'll know exactly what you're looking at and how they are going to present themselves in your chart. So again, trading is not difficult. Okay, this stuff repeats again and again and again. When we begin as a trader, there's a lot of information, but before you know it, it will repeat every single day, every single week, and every single month. And it's like learning any new skill. It just takes a little bit of time. But before you know it, you'll have all your information and you will be trading profitably and creating your wealth on your trading account. And again, all doable. It's just about being consistent, putting the work in, and trading on the correct side of the market. And that's the aim of this course, is to get you trading on the correct side of the market. So back to our bullish candlesticks. Abandoned baby bullish. Like most of the 3-day star patterns, the scenarios are similar. The primary difference is that the star second day can reflect greater deterioration in the prior trend, depending on whether the gap is doji and so on. Okay, so a belt hold bullish. The market is trending when a significant gap in direction of the trend occurs on the open. From that point, the market never looks back. All further price action that day is in the opposite of the previous trend. This causes much concern and many positions will be covered or sold, which will help accentuate the reversal. So as we were saying, a short squeeze, okay, or a short covering, when the people who have already gone short in the market now are buying and the market gets pushed up, okay, and it's generally quite a strong candle. And again, we refer back to our moving averages, our Fibonacci levels, our support and resistance levels, our pivot points, which we'll cover later on in this intermediate course. When these levels get hit, you can have extreme moves. This is why we're patient. We wait on these levels to get hit, and when they get hit, that's your trade. Your 50, 100 points, 50, 100 pips within an hour or two at the correct point, because they can be quite violent moves. And if you're in the correct direction, all you have to do is hold your trade, okay, place your stops at the correct positions, and off we go. Okay, so that's why it's so important to have your trade plan in place before you open any trade, okay? Because you want to know your resistance levels above and your support levels below to give you a higher probability trade. The concealing baby swallow bullish, okay? Anytime a downtrend can continue with two Marubozu days, okay, and what that means, it's a candle that has no wicks, just a full body, okay? So a Marubozu, no wicks. See this candle here? It's a full body and there's no wicks on either end, okay? So when this occurs, the bears must be excited. Then on the third day, the open is gapped down. On the third day, we have our gap down, which also adds to the excitement. However, trading during the day goes above the close of the previous day and causes real concern about the downtrend, okay? So the price gapped above, okay, the previous close and the downtrend, even though the day closes at near its low. The next day opens significantly higher with the gap, okay? After the opening, however, the market sells off and closes at a new low. This last day has given the shorts an excellent opportunity to cover their short positions. Okay, so cover their short positions. What are they looking likely to do? Close off their trade. And when they close off their trade, they're buying back. Okay, so they're buying off a significant low because they want to take profit, and the market should buy back in the next session. Okay, so these are the patterns you'll be looking out for. Breakaway bullish. It's important to realize what is being accomplished here. The trend has accelerated with a big gap and then starts to fizzle, but it still moves in the same direction. The slow deterioration of the trend is quite evident from this pattern. Finally, a burst in the opposite direction completely recovers the previous 3 days price action. What causes the reversal implication is that the gap has not been filled. A short-term reversal has been taking place. Okay, so the gap here, it hasn't been filled. Okay, so that's what you're looking for breakaway bullish. Again, we want to see the gap being filled. Engulfing bullish. A downtrend is in place when a small black body day occurs with not much volume, as we can see here. The next day, price open at new lows. Okay, we fall down to new lows and then climb to a 2-day high. So we've broken out above the 1-2 previous sessions. The rise is sustained by a high volume, a good high volume candle, and finally closes above the open of the previous sessions. Okay, here's our close. Emotionally, the downtrend has been damaged. If the next third day prices remains higher, a major reversal of the uptrend has occurred. Hammer bullish. The market has been in a downtrend, so there is an air of bearishness. Okay, the market opens and then sells off sharply. However, the sell-off is abated and the market returns to or near its high for the day. The failure of the market to continue the selling reduces the bearish sentiment, and most traders will be uneasy with any bearish positions they might have. If the close is above the open, causing a white body, the situation is even better for bulls. Confirmation will be a higher open with yet a still higher close at the next trading day. So as you can see, the market opened lower, but there was no volume. Okay, it's just a spike down, a hammer. It's called a hammer because the market is trying to hammer out a bottom. Okay, but where did the price close? It closed higher. Okay, then it's open, and the next day we're looking for a continuation, and that's a hammer. So when you can see this at the bottom of a bull trend, the market is trying to hammer out a bottom, and we're looking to buy back. Okay, so a higher probability trade would be to wait for a confirmation and use this as a support level here, and then the next session try to buy off those levels to continue a bullish trend. A harami bullish. Okay, a downtrend has been in place for some time. A long black day with average volume has occurred, which helps to perpetrate the bearishness. The next day, prices open higher, which shocks many complacent bears, and many shorts are quickly covered, causing the price to rise further. The price rise is tempered by the usual latecomers seeing this as an opportunity to short the trend they missed the first time. Volume on this day has exceeded the previous day, which suggests strong short covering. The confirmation of the reversal of the third day would provide the proof needed that the trend has reversed. Okay, so a strong body down, but the market on the next session is looking bullish. Okay, for a continue again, we want to close above the bearish candle, but this could be the start of it. Okay, the harami cross bullish. The harami cross starts out the same as that of the basic harami pattern. A trend has been in place when all of a sudden the market gyrates throughout the day without exceeding the body range of the previous day. What is worse, the market closes the same price it opened. Volume of this doji day also dries up, reflecting a lack of direction for traders. A significant reversal has occurred. Okay, so the market again, we're in a downtrend, long black candle, but the next day we see this indecision. There's no volume. So the sellers are looking to be gone. Okay, again, we're looking for confirmation the next day, but when we see this, there's no lower low. Okay, it's been stopped in its tracks and there's no sellers to push it lower. So that's a harami cross bullish. High price gapping play bullish. The high price gapping play is the bullish counterpart to the low price gapping play and leads to a new rally out of a stalled upward trend. This pattern is an upside window from a high price congestion band. After a sharp advance in the market consolidates via a series of small bodies near recent highs. If the price gaps above consolidation, it is a buy signal. Okay, so the gap is up. Okay, so consolidation would be if the market continues to buy. Okay, we're in an uptrend. You've had 3 small volume days. The price is gapped up. Okay, so it's the price stays above the gap. We have a consolidation and it's a buy signal, and we're looking for a confirmation for the buy to continue. Okay, so that is our high price gapping bullish. Homing pigeon bullish. The market is in a downtrend, evidenced by a long black day. The next day, prices open higher, trade completely within the prior day's body, and then close slightly lower. Depending upon the severity of the previous trend, this shows a deterioration and offers an opportunity to get out of the market. Okay, you can see our downtrend, but this price here, this candle, didn't close lower. Okay, so we may have a lack of sellers and we're looking for a market to be bullish. Okay, so we can see that the market closed within the previous the previous candle. It didn't go above or below, so there was no confirmation that it wanted to sell off. And what are we looking for it to go bullish? We want a confirmation to sell higher, so you want to close above this previous candle. Inverted hammer bullish. A downtrend has been in place when the market opens with a down gap. A rally throughout the day fails to hold and the market closes near its low. Similar to the scenario of the hammer and the hanging man, the opening of the following day is critical to the success or failure of this pattern to call a reversal of a trend. If the next day opens above the inverted hammer's body, a potential trend reversal will cause shorts to be covered, which would also perpetrate the rally. Okay, similarly, an inverted hammer would easily become the middle day of a more bullish moving star pattern. So there's our inverted hammer. So hammers are good clean candles to look out for. So just be aware of what they mean, okay? Because when you see these forming, okay, it's a great place to take a trade because the reaction can be quite quick. Okay, so you see one of these forming, whether it's on an hourly, 4 hourly or daily, it's time to take action. You may see them on a lower time scales again. Again, the higher time scales is what we're looking for, half hourly at least up to an hour. When you see one of these forming, it can really change the direction, even if it's only for that day's session. But an inverted hammer or hammer formations are ones to look out for, and again, they're quite easy to spot. Okay, they're quite unique candles to see. Kicking bullish. The market has been in a trend when prices gap the next day. Okay, the price never enters into the previous day's range and then they close with another gap. Okay, so the market's gapped up and it never came back. Okay, it never came back and it stayed above. Okay, we can see it on our Euro USD. On our gap play here. Okay, the market gapped. Okay, gapped down. Okay, and we can see it again on our USD JPY. The market gapped and it never recovered. Okay, back to our long-legged doji bullish. The long-legged doji has a long upper and lower shadows with the open and the close very close or the same. This pattern reflects the indecision of the buyers and sellers. The open and the close of the day are very close or are the same. The lower and upper shadows are very long. The low of the day is very low at the bottom of the trend. Okay, so that's a long-legged doji. Okay, so we can see a long candle with very little volume and indecision. And again, where are we getting our volume? We can see it on our candlestick formation. And again, we can go back to investing.com or Yahoo Finance, and you can see your volume figure for the day to get your confirmation. Matte hold bullish. The market is continuing its rise with a long white day confirming the bullish action. The next day, prices gap open and trade in a small range, only to close slightly lower. This lower close lower than the open is still a new closing high for the move. The bulls have only rested, even though the price action surely brings out the bears. The next couple of days cause some concern that the upward move may be in jeopardy. These days open about where the market closed on the previous day and then close slightly lower. Even by the third such day, the market is still higher and the open of the first day, a long white day. An attitude that a reversal has failed develops and prices rise again to close at a new closing high. This fully supports the bull's case that it was a pause in a strong upward trend. Okay, so again, we are in an uptrend and the market sells. Okay, just a small consolidation, profit taking, short covering, and then the market finds resistance and we're back into our bullish trend. So this can happen again on a shorter time scale from your hour to your 4 hour, but we're looking at our longer term trends, again, monthlies and weeklies and dailies. They're our long terms. So you'll always see price fluctuations, but again, it didn't break the resistance level and the market bought back up and we're still in our uptrend. The matching low bullish. The market has been trading lower as evidenced by another long black day. The next day prices open higher trade still higher, and then close at the same price as before. This is a classic indication of a short-term support, will cause much concern for any apathetic bears who ignore it. Apathetic bears are short in the market and quite comfortable with their short position. If they ignore the matching low as a possible trend reversal, it will cause much concern. Okay, the price didn't break below in 2 days. We had a strong downtrend, or a strong black candle, strong selling. Again, the second day, selling again, but it would not break below. Okay, it's finding support, solid support, especially on a daily. 1 day, 2 days, and we've solid support. More than likely, the sellers have run out of steam, and you may see buyers return. So this is why the sellers might be getting uncomfortable, and they may want to lower their exposure because you may have a buying opportunity. Okay, but always confirmation first. These patterns, we need confirmation with them constantly. Confirmation, I mean, your support and your resistance, your moving averages, your fundamental data. We're not just trading off these patterns. We need to have a full view of the markets, okay? So meeting lines bullish. The market has been in a downtrend when a long black day forms, which further perpetuates the trend. The next day opens with a gap down, then rallies throughout the day to close at the same close as the previous day. This fact shows how price benchmarks are used by traders. The odds of are very good that a reversal has taken place. If the third day opens higher, confirmation has been given. Okay, so we found support in the market, and the market is starting to buy back again. We're at the neckline for confirmation. The meeting lines we want to close above, and then this will be our support base, and that's where you will place your stop. Okay, so you're looking for a close above and to continue our bullish price action. Morning doji star bullish. The psychology behind this pattern is similar to that of the morning star, except that the doji star is more of a shock to the previous trend and therefore more significant. Okay, so the market is selling off, no volume. Okay, it's stopped dead in its tracks, and then the next day we have a bullish candle. Okay, so it's a morning doji star, right at the bottom of a trend, and it's very unique. Once you see these forming, okay, you're looking to take a position. Okay, downtrend, stop dead in its tracks, and our confirmation is the next session bought up. Morning star bullish. A downtrend has been in place which is assisted by a long black candlestick. There is little doubt about the downtrend continuing with this type of action. The next day prices gap lower on the open, trade with a small range and close near their open. This small body shows the beginning of indecision. The next day prices gap higher on the open and then close much higher. A significant reversal of trend has taken place. Okay, so again, our downtrend has been broken. Okay, it stopped dead in its tracks, and the next day the market has significant buying. And again, where do we get our confirmation? We need a close above this level. Okay, so we're always looking for supports and resistance. So our support has developed. This level here at the top of the candle will be our resistance level, and if price breaks above, we can continue our bullish uptrend. Piercing line bullish. A long black body forms in a downtrend which maintains the bearishness. A gap to the downside on the next day's open further perpetuates the bearishness. However, on the day after, the market rallies all day and closes much higher. In fact, the close is above the midpoint of the body of the long black day. This action causes concern to the bears and a potential bottom has been made. Candlestick charting shows this action quite well, whereas standard bar charting would hardly concern it, okay, or discern it. So we can see it again, okay, long black candle, but the body of the bearish or the bullish candle has closed above the low. Okay, so we're looking for it's a piercing bullish candle. It's pierced back above, and a potential bottom may be in place. Rising tree methods bullish. The rising tree methods pattern is considered a rest from trading. The psychology behind a move like this is that some doubt creeps in about the ability of the trend to continue. This doubt increases as the small range reaction days take place. Okay, however, once the bulls see that a new low cannot be made, the bullishness is resumed and new prices are set quickly. Okay, so we have a bullish trend. Again, the market, 3 rising star methods. The market is trying to sell off, but it can't break below our support level, and again, a bullish candle to confirm that the bull trend is still in place. Separating lines bullish. While the market is in an uptrend, the forming of the long black body should be a cause for concern, as this is unusual for a strong market. However, the next day opens much higher. In fact, it opens at the previous black day's opening price. Prices then move higher for the rest of the day and close higher, which suggests that the prior uptrend should now continue. So in a strong uptrend, we can still have a down day. A news event, okay, we might have a GDP figure, okay, we might have a retail sales figure, we might have a political event, and it's just a one day or one session where the market sells off. But again, the market reacts, it takes into consideration that it's not going to break the uptrend, and we continue. So again, no matter if it's a strong up or down trend, there's always going to be price fluctuations. So this is why we're constantly evaluating the market. Okay, in the strongest bull trend or the strongest bear trend, there's always going to be price deviations, price fluctuations. So this is why we always put risk management first, and why we always look to trade with our stops in place and our trade plan. And we'll be discussing risk management and stops later in the course. Side by side white lines bullish. A market is in an uptrend. A long white candlestick is formed, which further perpetuates the bullishness. The next day, the market gaps up and open and closes still higher. However, on the third day, the market opens much lower, in fact, as low as the previous day's open. The initial selling that caused the lower open ends quickly, and the market gaps to yet another high. This demonstrates the force behind the buyers, and the rally should continue. Okay, so we gapped up, still in an uptrend, and the market tested a low, but again, we're still in a bullish formation. Stick sandwich bullish. A good downtrend is underway. Prices open higher on the next trading day and then trade higher all day, closing at or near the high. This action suggests that the previous downtrend has probably reversed and that shorts should be protected if not covered. The next day, prices open even higher, which should cause some covering initially, but then price drift lower to close at the same as 2 days ago. Anyone who does not know the support and resistance points in market is taking an exceptional risk. Okay, another day of trading should tell the story. Okay, so we had a down day, the market bought back up on a bullish candle, and on our third day sold, but we came into support. Okay, so we're looking for confirmation the next day, and we have a sandwich. Okay, the price is sandwiched between 2 bearish candles, so our next candle will give us our confirmation. But what are we looking for? We have solid support. Okay, we've broken out of one candle, we couldn't quite break out, so we're in that range, and until our range breaks, we need confirmation to take that trade. Okay, and our first confirmation, a safe trade, would be to trade off the support here. Could be a buy zone. If it broke below, okay, well, your confirmation has changed now that it's bearish. But if it breaks above, you've got your bullish confirmation. So we're constantly looking for evaluating and looking for points where we're entering and exiting. No one's going to tell you that tomorrow the market is going to do this or it's going to do that. Okay. We're looking for levels to enter and exit, and these patterns are giving us an indication. They're used with our other tools to give us a high probability trade. 3 inside up bullish. This pattern, being a confirmation for the bullish harami, can only show the success of the previous forecast. The bullish 3 inside up is a confirmation pattern for the bullish harami. Its pattern is defined by first 2 days of the 3-day pattern forming a bullish harami, and the third day giving support to suggest a reversal of the harami by being a white candle closing with a new high for the 3 days. Now that's a mouthful. So your harami, what is your harami? It's within the previous day's candle. Okay, so we have a down candle and we have a harami forming. And on the 3rd day, our confirmation is bullish. The price has moved up. Okay, it hasn't moved down. So our harami has formed inside the body of our previous candle, and our 3rd session, the market is bullish, and we've closed above this, and we're into a bullish formation. 3-line strike bullish. The market has continued in its trend, aided by the recent 3 white soldiers pattern. The 4th day opens in the direction of the trend, but profit taking or short covering causes the market to move strongly in the opposite direction. This action causes considerable soul searching, but remember that this move completely eradicated the previous 3 days. This surely dried up the short-term reversal sentiment, and the trend should continue in its previous direction. Okay, so our downtrend has taken out our 3 up days, but we're coming into support there. Okay, so that's why the action would cause considerable soul searching if you are you're looking to buy. But what are we looking to do? We're looking for supports. Okay, no matter how extreme the move is, there's always a support level. Okay, where the market will find support and rally. If the support breaks, okay, then that has become resistance. Support becomes resistance. Resistance can become support. So we're always looking for price levels where the market will break through, as we've discussed in with our technical indicators. 3 outside up bullish. This pattern representing the confirmation of the bullish engulfing pattern can only show the success of the forecast. The bullish 3 outside up is a confirmation pattern for the bullish engulfing. Its pattern is defined by the first 2 days of the 3-day pattern forming a bullish engulfing, and the 3rd day giving support to suggested reversal of the engulfing by being a white candle closing with a new high for the 3 days. Okay, so we've a small low, we've a reversal candle, and we've closed above, and again continuation. So we're looking for higher highs there. Okay, higher high and higher high. 3 stars south, 3 stars in the south bullish. Okay, a downtrend has continued when after a new low has been made. A rally closes well above the low. This will cause some concern among the shorts because it represents buying something that has not been happening until now. Okay, the 2nd day opens higher, which lets some longs get out of their positions. However, that is the high for the day. Trading is lower, but not lower than the previous day, which causes a rally to close above the low. The bears are certainly concerned now because of the higher low. The last day is a day of indecision with hardly any price movement. Anyone who is who's still short will not want to see anything more to the upside. Okay, so we had a sell-off with a higher close though. Okay, with a low here, but with a higher close, and again indecision on the 3rd day. The market may be bottoming out. Okay, we had a low, a higher low, and a higher low, no wick. So the market may be the sellers may be running out of steam. We may have a reversal pattern in place. 3 white soldiers bullish. The 3 white soldiers pattern occurs in a downtrend and is representative of a strong reversal in the market. Each day opens lower but then closes to a new short-term high. This type of price action is very bullish and should never be ignored. 3 strong candles. Okay, higher highs, higher highs, higher highs. Okay, higher probability trade is a continuation, especially if the long-term trend is bullish. That's our 3 white soldiers bullish. Okay, tri-star bullish. The market has probably been in a downtrend for a long time, with the trend starting to show weakness. Bodies probably are becoming smaller. The first doji would cause considerable concern. The second doji would indicate that there was no direction left in the market. Finally, the 3rd doji will put the last nail in the coffin of the trend. This is essentially because the pattern indicates too much indecision, and everybody with any conviction would be reversing positions. Okay, so the market's in a downtrend, but we're completely running out of steam. Indecision and no volume. 2nd session, indecision and no volume. 3rd session, indecision and no volume, but creeping back up. Okay, it's looking like the buyers may be returning. So a tri-star bullish formation. Unique 3 river bottom bullish. Okay, a falling market produces a long black day. The next day opens higher, but the bearish strength causes a new low to be set. A substantial rally ensues in which the strength of the bears is in question. This indecision and lack of stability is enforced when the third day opens lower. Stability arrives with a small white body on the third day. If on the fourth day prices rise to new highs, a reversal trend has been confirmed. Okay, so as you can see, this hammer formation, hammering out a bottom. On our next day, the market has found a higher low. It's closed above the previous day's low. It's a bullish candle, and we're looking for a confirmation to buy above. But this candle here with the hammer low is really our indication that the market is looking to bottom out. Okay, upside gap tree methods bullish. The market is moving strongly upward. This move is extended further by another day that gaps even more in the direction of the trend. The third day opens well into the body of the second day, then completely fills the gap. This gap closing should be looked upon as supporting for the current uptrend. Gaps normally provide excellent support and or resistance points when considered after a reasonable period of time. Because the gap is filled within one day, some other considerations should be made. If this is the first gap of the move, then the reaction third day can be considered as profit taking. So we can see our gap, okay, and it gapped up, and then the market sold. So you'll be looking to take some profit here. We had a nice gap up. We're still in an uptrend, but again, you may want to be taking some profit off the market on the third day, okay? Because the gap there has been closed. So the gap closing move should be looked upon as a support for the current uptrend. You want to find support here, and the market continues up. Okay, so even though the market has sold off on the third day, we're still in an uptrend once we find support and a close above the gap there. Upside Tezuki gap bullish. The psychology behind a Tezuki gap is quite simple. Go with the trend of the gap. Okay, go with the trend of the gap. Just again with our USD/JPY, go with the trend of the gap. The gap sold off hard, and the market continued to sell. So if you opened up on Monday morning, you might not get this trade. Okay, but look, we're finding resistance. The market did fall off, came back up, and it found resistance. It couldn't buy back the gap. Okay, so you're selling, selling, selling. Now we've broken back above the gap, but for a continuation of this move, again, we need to break above here. But on the initial drop, okay, you might not get this move. It'll happen very quick. It'll happen in seconds, and you may have missed the move. But to continue trading consistently, you want to trade in the direction of the gap, and the gap is down. Okay, so you just continue the trend, and the market sold, and it went lower, okay, than the initial sell-off. It kept, and then it bottomed out. But initially, you go in the direction of the gap. Okay, so the correction day, the third day, did not fill the gap, and the previous trend should continue. This is looked upon as a temporary profit taking. The Japanese widely follow gaps, or as they call them, windows. Therefore, the fact that the gap does not get filled or closed means that the previous day's trend should continue. Again, as we've seen, the previous day, this was Monday, and the market kept selling off into midweek, okay, before it started to reverse. So until the gap was finished or closed back above, the market stayed in that downtrend. And that really is our detailed look at our price patterns. Okay, so in summary, I want to add that the candlestick patterns should not be traded in isolation. Always refer to the major trend first. Okay, this will give you the main picture of how the price is trading. The candlestick patterns are one more tool for your trader's toolbox, and over time you will be able to recognize them in real time, but again, also use them in conjunction with your other tools, i.e. your trend line, your technical indicators such as your moving averages, and also using your fundamental analysis. Always use a step-by-step approach when trading, so each trade has 4 or 5 solid reasons why you're entering the trade. For example, the main trend is bullish, okay? The price is also above your 100-day moving average. A positive news event has occurred, and you are now spotting a bullish candlestick pattern emerging. there's 4 solid reasons why you're entering this trade. Okay, this will give you the confidence to enter your trade. It will build discipline that every single trade must be planned in advance, and this in turn will lead to consistent profits in the market. So thank you for listening to our module on the further study of candlestick charts, and I hope you will enjoy our next module on continuation and reversal patterns. So thank you very much, and goodbye.